Good day, everyone. We are from Group 8. We are from Group 8, going to present. We have choose two case study, which is Teletech and Wrigley. For the case study Teletech, we will presented by Yuhan, Togemara, Shami, and Sudarshan. And for the Wrigley case, we are presented by Chong, Jason, and Sham. For the first case, we'll start with our problem statement, which is the Teletech document content, which is corporate trader with the usering has got 10% of stake in Teletech and with demanding changes to the way the company allocates capex for its two business segments. The Teletech, the two segment will be telecom, which is accounts for 75% of its market value given for return of capital, which is 9.10%, while its product and services given for 25% its market value and return of capital will be 11%. The company uses a hurdle rate of 9.30, uh, weightage average cost of capital, evaluate the capital expenditure. These practices being challenged internally and externally due to the different risk profile of the two business segments, with the central question being how capital allocated should be done to maximize the value of firm. So the hurdle rate, Teletech currently employs a single corporate-wide hurdle rate of 9.30% for evaluating all business segments, including telecommunication services and product and systems. This uniform rate is used for capital budgeting decision, performance evaluation, and resources allocation regardless of different risk profile. On the WACC estimate for the Teletech business segment, we have calculated using the given tax rate of 40%. We have identified after tax cost of debt will be for telecom 3.44%, product and system will be 4.48%, and corporate will be 3.53. And for the cost of equity for the telecom, 10.34% reflect the lower risk and cost of equity. Product and system will be 12.10, higher cost due to greater risk, and corporate will be 10.95% average to balance the segment, which is assumed even under the multi-hurdle model, the cost of equity and the debt, as well as the ratio of debt and equity is evenly shared by both segments of the business. This is because of corporate level, this company takes on debt and retains equity funding as a whole and its channel internally to each business and segment. Assume that telecommunication segment, the beta will be 1.10, which is WACC will be 8.8%, which less volatility due to stable operation. And also for the product and system, maybe the beta I've identified 1.36, which is WACC will be 10.4%. And next will be the analysis of the Wrigley graph case, which is Mr. Philip graph illustrate that under a single 9.30% hurdle rate, the lower risk telecommunication segment has a return below to the rate, while the higher risk products and services segment has a return above it. This disparity leads to capital allocation favoring telecom. To address this, Mr. Philip introduced an adjusted hurdle rate that increases with risk. Lower risk requires a lower hurdle, while higher risk will take a higher return. With this adjusted hurdle, telecommunication returns exceed the rate, while product and systems fall short. This suggests that telecom exceeds its true hurdle rate, while product and system falls below. Adopting this new curve would result in capital allocation going to telecom communication instead of product and system. So this analysis on the WACC segment will be okay. The internal adjusted WACC telecommunication is 8.81, consistent with Mr. Phillips' graphs, which is reflects lower risk and funding cost. It meets hurdle rate 9.10 of return of capital, which is 8.81%. The internal adjusted WACC for the product and system is 10.10, which is higher risk leads to higher required return, lower than projected for 14%. It meets the hurdle rate of 11% of return of capital compared to 10.41%. For the next slide, I'll pass to Shami. Thank you.
So thank you, Sam. Since Teletech were using economic profit as a mean of making capital allocation decision, we may make further calculation to expand the case. Referring to the slide is the analysis of the economic profit, the two business unit based on the single hurdle and multi-hurdle evaluation. So by using the single hurdle rate of 9.3%, the telecom segment appeared to contribute negative economic value due to its return on capital falling below the hurdle rate, while the P&S segment demonstrates disproportionately high economic profit as its return on capital exceeds the hurdle rate. However, when using adjusted WACC for the individual segment, the telecom segment shows the positive economic profit and the P&S segment also remain profitable, albeit with a lower economic profit compared to the single rate calculation. This indicates that both segments are economically profitable to the company when evaluated with segment-specific WACC adjustment. So next slide. So considering a scenario where the company plan to invest 2 billion in the coming year in either the telecom or P&S segment, which are mutually exclusive, the interpretation of calculation under the single hurdle rate model of 9.3% revealed that telecom would generate a negative economic profit, indicating a negative return and should be avoided, while the P&S segment would yield a positive economic profit of 34 million, suggesting a high and favorable return, making it the priority. Under the multi-hurdle model, the telecom segment would show a modest positive economic profit of 5.8 million, while the P&S segment would still outperform with the economic profit of 11.8 million, demonstrating a relatively higher and more attractive return compared to telecom. So the next is the conclusion. So Ms. Philip from the telecom division want all the fund to go to his division, while Ms. Haley from the P&S division want all the fund for her division. Both are pushing for what benefit their own division. The single hurdle model, which uses one set target for return, shows the telecom division as unprofitable and the P&S division as very profitable. However, this can be misleading and cause bad decision making because it doesn't reflect the full picture. Most leaders have reason to argue for more fund for their own division. When using more accurate method called adjusted WACC, both divisions are actually helping the company overall. The multi-hurdle model shows that the telecom division is making a positive profit, but it's lower because it has less risk. This suggests that as long as the telecom division continue, the company can expect steady return. On the other hand, the P&S division is making a higher profit, but it's come with more risk. A key point here is the P&S division is benefiting from the company overall capital structure. So for the next slide, I pass to Sudhir.
Thank you, Shami. Good day, everyone. I'll walk you through the analysis of focusing on the financial impact of using a single hurdle rate and also its implications for the telecom and product and system segments. Starting off with the single hurdle rate approach, where this method simplifies decision making by providing a consistent benchmark for evaluating investments. It also ensures uniformity across segments, promoting fairness and enabling consistent performance evaluations over time. However, the single hurdle rate has significant drawbacks where it fails to account for the unique risk profiles of each segment. For example, Teletech's telecom and product and system divisions operate in vastly different environments, which means a single benchmark might lead to misalignment of priorities, where high risk projects will high returns could be favored over low risk, sustainable ones, and also potentially increasing the company's overall risk profile. So in this slide, you can see that the asset weighted here allocations to 100% allocations to telecoms. Here the financials are quite encouraging with a A bond rating. The after-tax cost of debt is just 3.44%, while the cost of equity is 10.34%. Together, this yield a WACC of 8.47%. Percentage, which is below the segment's return of capital ROC of 9.1% percentage. So this translates to an economic profit of 100.61 million, a clear indicator of profitability, and also the balance or mix of debt and equity funding plays a critical role in achieving this outcome, showcasing the benefit of leveraging the lower cost of debt. Going on to the next slide will be 100% allocation to PNS. On the other hand, the product and systems segment faces challenges where the BB bond rating increases the after-tax cost of debt to 4.48%, while the cost of equity is higher at 12.1%, where pushing the WACC to 11.4%. So although the segment achieves a ROC of 11%, it falls short of covering its WACC, resulting in a negative economic profit of negative 63.86 million. The reliance of equity funding significantly raises cost of in this segment, making profitability unsustainable under the current structure. Where to conclude, the analysis clearly highlights a critical issue in the product and system segment, as the cost of equity funding increases, coupled with the higher percentage of equity in the funding mix, the overall cost of financing becomes significantly high, and this directly impacts profitability, making the entire PNS business segment unsustainable under its current financial structure. Addressing this requires a strategic shift towards a more cost-efficient debt financing to lower the WACC and enhance the segment economic viability. So passing on to Johan for the following slide.
Thank you, Sudhir. So after having analyzed the internal corporate situation within Teletech, the management has to then prepare a response to the corporate raiders' intention to overhaul the company. Based on the media articles, the company has put 2 accusations and 2 counter proposals to the management, and the management was required to prepare a response to them. Here we go through the accusations and the proposed answer from management towards the accusations that are put. The first radar accusation was that the firm is misusing its resources, and Teletech's responses should be that the firm isn't misusing its responses, and the economic profit calculations that it has been used as a basis of making capex allocation clearly shows that there is a positive economic profit to the company of 48 million under the single tier system, and up to 63 million potentially under a multi-tier calculation hurdle rate. And so this illustrates clearly that the resource utilization that management has allocated has been generating value, and the Teletech management is continues to improve its capital allocation framework to be more efficient and transitioning towards a better internal financial modeling process with multi-hurdle rates, demonstrating their commitment to optimize their resource planning capabilities. The second accusation that the rater had was that the firm is not earning enough returns for the company. And for this, Teletech should respond and demonstrate from the return on equity calculations that it's actually exceeding the cost of capital that it has been using, creating values for shareholder, and all this while balancing the act of also investing into a new business segment for growth, which is the PNS statement, PNS segment. The company is also constantly reviewing its capital allocation framework to ensure that the efficient resource is deployed. And recent steps towards improving its internal financial modeling, transitioning from a single hurdle rate to a multi-hurdle rate will contribute towards that. And so all of this would still align towards maximizing the shareholder returns for the firm. Next slide, please. The first proposal from the rater was that the company should abandon and sell its PNS segment, being the higher risk business segment. And on this front, Teletech should respond that the PNS business segment is part of its diversification and growth strategy. And the current corporate structure mitigates the potential downturns of the telecoms business. Having two businesses is extremely useful in case one particular segment goes down and reduces their risk of exposure. The PNS segment also demonstrates a significantly high growth rate compared to the PNS, to the telecom segments, 40% versus 3%, enabling Teletech to grow in size and valuation as long as it continues to invest in the PNS segment of the industry. Abandoning that PNS segment now would basically hinder their long-term goals and reduce the benefits that will give from a diversification. There are synergies that exist between services and equipment business, enhancing the customer offerings and operational efficiency. And while the company acknowledges that the CapEx allocation model can be improved, the internal checks reveal that the PNS segment is contributing positively, 11% versus the internally calculated 10.64%, indicating that the company has not lost value or lost money as a result of venturing into the PNS business segment. And lastly, the rater proposal mentioned that they would like management to focus on creating value for shareholders. And on this portion, the Teletech management should agree and emphasize that Teletech values transparency and accountability, and will continue to engage its shareholders in these capital allocation exercises and refreshments. As a 10% shareholder, this new investor can appoint the members to its board of directors to engage in constructive criticisms for growth. The Teletech management can propose to form a shareholder advisory committee to review the investment policies and to ensure that align the short-term and long-term objectives of the company with the policies on the capital allocation to ensure that there is a positive economic returns on the thing. And this is a portion there that they can invite the raters to come in to give constructive criticism rather than to have a hostile takeover from the external. And thank you. That concludes our analysis of case for Teletech. I will pass to my classmates for the Wrigley case.
All right, thank you, Johan. So basically, now we are going to present the case for Wrigley. So next slide, please. I'm Jason, and we have other two teammates as well to present this part. So let me give you a brief summary on the case study. So basically, all of us know that Wrigley is quite a famous bubblegum company, a chewing gum company. So in this case, actually, it's being proposed that Aurora Borealis, they are a consultant company. They would like to suggest Wrigley to actually take up 3 billion debt to actually recapitalize their structure. And then this in the following slides and also analysis, we're actually going to analyze on this strategy, whether is it really beneficial to bring on this 3 billion debt. Okay, next slide. Okay, so basically, as I mentioned just now, we are going to analyze some of the analysis, which includes the capital structure, and also whether it's really beneficial for shareholders. Will it create more value to the shareholder after recapitalizing with this debt? And also the risk, whether this 3 billion debt will actually bring a higher risk, or is a risk actually mitigatable? And also the voting control, whether after getting this debt, will Wrigley's family actually have a higher voting control, maybe a lower voting control overall? Okay, next slide. So we are gonna tackle all these questions basically. So the first one is actually to analyze the changes in the value of the firm after relevering, and then the second one is basically to impact to see if there's an impact on the WACC and also the credit rating after getting the debt. And so question 3 is about to analyze the merits of dividends and also the share purchase as a means of returning cash to the shareholders. While question 4 is to decide whether the managing director of the hedge fund is actually hoping to accomplish through her active investor strategy. And also question 5 is basically to sum up all of the analysis above, including the EPS, and also the book of equity and the debt interest coverage ratio and financial flexibility, which we analyzed just now, also the voting control. And the lastly is about the consultant, whether is it really good to actually convince Wrigley directors to actually undertake the recapitalization, which is to take up the debt of the 3 billion. Okay, let's proceed to question 1. Okay, so in the slide here, we can see that we are going to analyze the potential change in the value for after relevering by taking the 3 billion debt to the capital structure. So we are going to use the adjusted net present value analysis method. So firstly, we are going to calculate the tax shield. So this is actually beneficial to the company because after getting this 3 billion debt, the company will actually have a tax shield of around 1.2 billion. So taking this 1.2 billion into consideration, we can actually calculate the relevered value of the firm. So the total value is actually 14.3 billion after relevering. And then with this new value, we can calculate the new share price based on the current outstanding shares in the market. So the new share price will be around $61.53 per share. And then based on this $61.53 per share, Wrigley's will be using the 3 billion of the debt to actually repurchase the share. So they will actually manage to repurchase around 48.76 million shares overall. And then after repurchasing the shares, the outstanding shares in the market will be around 183.68 million. So in a summary, so this after taking up this debt and to recapitalize, it would actually increase Wrigley's firm value from 13.1 billion to 14.3 billion due to the tax shield. So this is actually beneficial and also helping to increase the overall equity in the company. So after this, it will actually helps to affect the market price per share, increasing it to around $60.53. So this actually shows that it helps to enhance shareholder value through the tax advantage, where, as I mentioned just now, which is the tax shield. And so this actually helps to signal confidence in the company's future performance. Okay, next slide. Okay, so proceeding next, we'll be tackling the weighted average cost, which is the WACC. So before releveraging, the WACC basically the cost of equity. So with the given values, we actually calculated, and then the WACC before relevering is around 10.9%. So after recapitalization, because of the increase of leverage will actually affect Wrigley's WACC because there will be a change in the stock's beta. So taking the consideration of the beta, we managed to calculate the cost of equity, which is around 11.7%. And then to calculate the new WACC, we need both cost of equity and so cost of debt. So the cost of debt after tax after relevering would be around 7.8%. So taking both values into consideration, we can actually calculate the WACC after releveraging. So it will be around 10.87%. So based on both values, we can actually conclude that there is actually not much difference between the WACC before releveraging and also after releveraging. So this is because basically Wrigley is a very huge company, and also their equity is so large with around 13.1 billion. The 3 billion more in debt actually doesn't really make much difference to the debt and equity ratio. So, and also the levered beta formula to calculate the new cost of equity actually doesn't really take the cost of financial distress into consideration. So in short, the tax benefit actually managed to benefit by actually using more debt to offset the higher cost of equity. But most importantly, as I mentioned, is now the formula for the beta actually fails to reflect the cost of financial distress. Okay, next slide. Okay, so moving on next, we will be analyzing about the debt interest coverage ratio to know more about the financial flexibility, and also to give us to sum up about the credit rating of Wrigley's after getting the 3 billion debt. So based on the given values, and we know that the debt is 3 billion, and then the 3 billion, there's a typo over here. So the debt is 3 billion, and then the interest rate will be 13%. So based on that, the interest expense would be around 390 million. And then with this interest expense, we can actually calculate the debt interest coverage ratio, which is the ICR, and then the ICR is around 1.32. So even though the ICR is above 1, and it's still relatively low, so it suggests Wrigley might have potential difficulties in covering their interest payments if their earnings decline in the future. Ideally, firms should actually achieve ICR of 2%, ICR of 2 to actually have a higher financial stability. And then we will be analyzing the financial flexibility next. So based on the net cash flow after interest payment, we can calculate that Wrigley have around 123.36 million of net cash flow after interest payment. And then to evaluate the financial flexibility, we are using the financial flexibility ratio formula. So dividing the new cash flow from the new debt, we managed to calculate the ratio of 0.041. So this means that for every dollar of the new debt issued, Wrigley has about 4.11 cents available in their cash flow after covering interest expense. So this low ratio might suggest the Wrigley's limited ability to actually respond to unexpected financial challenges in the future. So in short, after leveraging, a credit rating between BB and B, because previously Wrigley's doesn't have any debt, so they have a credit rating of A. So after getting this debt, the rating will be dropped to BB and B. So this demonstrates an increased risk, so it may affect Wrigley's ability to raise additional funds so to get more loans in the future if needed. So I'll pass on to my teammates next for the next question. Thank you.
So thank you, Jason. So I'll be presenting the question 3 to consider whether paying dividend or repurchasing shares are meant for returning cash to shareholders. So the merit for dividend include the consistency and shareholder preference, where regular dividend will be preferred by income-focused investor as there is predictable cash flows. And by dividend, it produces a signal of confidence in the company's stability and future earnings. And next, the dividends are distributed to all shareholders equally, which ensure that both institutional and retail investor will benefit from this. And also lastly, the dividend has a strong and consistent policy, which enhance investors' confidence and will potentially support the stock's price. But few drawbacks of dividends are it tax at the shareholder level, which makes them less tax efficient compared to share repurchase. And it sets a policy that whenever the company reduce or stop paying the dividend, it might negatively affect the investors' sentiments towards the company. And on the other hand, share repurchase has a merit like tax efficiency, where the share repurchase produce a tax efficient way of returning cash to shareholders, as they doesn't have the immediate taxation like dividend. On the other side, share repurchase has increased the earning per share EPS and often boost the share price, which will benefit the shareholders. Share repurchase program can be one-on-one time event and does not have to be paid regularly as what the dividend does, and which improves the relative to voting power of remaining shareholders. But still, share repurchase drawback where only shareholder who sell their shares will benefit directly from the share repurchase, which can be in favor of short-term investors over the long-term investors. So if shares are repurchased at a high price, it can be also result in inefficient capital use. And lastly, it signals that the company lacks in profitable reinvestment opportunities and potentially lead to negative perception about the growth prospect of the company. So moving to the next slide. what we can say is, in conclusion, so if the goal is to create value for long-term shareholders, share purchase are more preferred than dividends since they are tax efficient, improve EPS, and may enhance the stock price, which can benefit by higher capital gains. They also offer flexibility and align with the recapitalization strategy. While the goal if is to satisfy broad shareholders, dividend can be better suited particularly for income-focused investors as they ensure cash benefit for all shareholders and signal a steady growth performance. So Wrigley decision should align with its shareholder composition and strategy objective. So if the aim is to consolidate family control and enhance financial performance metrics like EPS, so the share repurchase program is better choice than the dividend payment. So moving on to the next slide on question 4. So what is the managing director of hedge fund hoping to accomplish through their active investment strategy? So by employing active investment strategy, the MD of hedge fund can aim to achieve several strategy outcome like key objective is to unlock Wrigley's untapped potential by restructuring its financial setup. So introducing leveraging into company's capital structure allow it to benefit from tax savings on interest payment while optimizing its financial mix. So next, the hedge fund is seek to influence Wrigley's critical financial operation decision. So this include advocating for significant financial maneuvers like leveraging the firm's through recapitalization or implementing shareholder friendly action like dividend or share repurchase to distribute surplus cash. And further, there are inefficiency in the current market valuation of Wrigley's, particularly due to its conservative debt-free financial approach. So this structure does not fully reflect the company's potential to generate higher shareholder return. So by initiate structural changes, the hedge fund plans to capitalize on this inefficiency and realize additional value that has not been accounted by for the market. And finally, hedge fund overreaching business model revolve around achieving substantial returns from active intervention. So Dobrin anticipates that leveraging Wrigley's will enable the hedge fund to reap significant financial reward driven by stock price gains following the recapitalization and cash distribution like dividend or returns generated through the proposed debt finance strategy. So that's all for me. I'll pass to Chong. Thank you.
Yep, sure. Thank you, Sham. Thank you, everybody, for the presentation so far. So now I'd like to move to question 5, which is just a sort of summary of what are the effects of this issuing of $3 billion of new debt. So primarily, we can analyze this from 2 perspectives. The first is the effect on the share repurchase, or rather the ownership of the company, and from the equity point of view. First and foremost, let's say if the company Wrigley's, they use the newly issued $3 billion debt to repurchase the shares at the current market price. And assuming for the best case scenario where they manage to buy all of it, all $3 billion is spent in buying the new stocks, the outstanding shares. We see that they can buy about 49 million shares as presented by Jason before, which leads to the shares outstanding to reduce from 232 million to 184 million. Now, leading up to this, we can see that, okay, the new net income of this company, thanks to its increased, thanks to its tax shield, number one, and its increased what's the word for it? Enterprise value will lead to the new income to rise to about 277 million. On the other hand, this will reflect into the earnings per share, the EPS, from $1.56 per share to about $1.51, which is almost identical. And on the other hand, we see that due to the reduction in the outstanding shares, the Wrigley family control is expected to increase from 21% to 27%. So yes, overall, we see that purchasing, there are some tangible benefits to the share repurchase program based on using this newly issued debt. On the other hand, let's look from the equity point of view. Taking on this new $3 billion debt will cause the book value of equity to decrease from 1.27 billion to negative 1.72 billion, which is negative equity. And this typically fares poorly in times of financial distress. So this may be something that you want to look into, and it's dependent on Wrigley's risk appetite at the time. The share price increase will increase due to rise of value from the tax shield, as mentioned before, from $56.37 to $77.86, which is an increase of about $21. And this new debt commitment interest coverage can be covered fully by the EBIT. And as mentioned before, the debt coverage is about 1.32, which again is not bad, but not great either. We would ideally want it to be around 2. On the other hand, if they didn't take on this debt, there would be no interest coverage, as in like it will be in an incredibly strong position. And yes, this is a drastic rise from a previously debt-free position, but again, it's still manageable, not ideal, but still good enough. So this summarizes the quantitative aspect of this of using this 3 billion debt to repurchase shares. Now, finally, question number 6, we would like to come to a conclusion, right? After weighing in the pros and the cons of taking on this extra $3 billion. Let's see, the pros for the Wrigley company is that it increases the firm value due to tax shield. Share price does increase, which benefits shareholders, as mentioned before by Sham. And the voting power of the Wrigley family does increase from 21% to 27%. On the other hand, the cons is that the downgrade in credit score from A to BB or B, which may lead to difficulty in borrowing in the future, and interest coverage from infinitely large, very, very strong position to a sort of satisfactory but not exactly great position at 1.32 times. And lastly, the negative equity in the book value indicates over leveraging. So in summary, we see that, well, there are pros, there are cons, but the cons seem to weigh much heavier than the pros. The pros, for example, the increase in enterprise value isn't that much. It's only about 30 to 40%. On the other hand, the voting power is only a 6% increase in voting power. So it's not a very big, not a very strong pro. On the other hand, the cons, a drop from A rating to a B rating is quite severe, especially if it drops to B, which is out of the investment grade. And on the other hand, the interest coverage, it's particularly obvious when you see that Wrigley has been issuing, has been in the green. They have been making money, having income, net income, and they have been issuing dividends for the past 3 years increasingly. So there is no desperate need for them to take on new debt just to pay out dividends. So it's highly unlikely that Wrigley would accept this proposal. So in short, to answer the question, we think that Aurora Borealis LLC and Blanca Dobrinin should not waste their time. It's highly unlikely that they will accept. So maybe they shouldn't bother to try to convince Wrigley. And that concludes our case study on Wrigley. Thank you, everybody.